Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Zscaler stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 35 billion market cap. They're trading at $237 a share and they have 148 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have really good free cash flow. It's consistent and it grows each year by about 100 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative every single year, which is kind of odd, but I guess they have lots of write-downs. I'm guessing they pay a lot in stock-based compensation, which brings down your net income, but it doesn't affect cash flow. Because when a company gives their own stock to their employees, it's a non-cash item. It's an expense on the income statement, but no cash leaves the company. Revenue is a sales for the company, and that looks great. It grows from 700 million to 1.8 billion. It grew 62% from 2020 to 2021, another 48% into 2022. Although a modest growth into the trailing 12 months, 9%. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 22 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company of $19 billion. We divide that by 148 million shares. And we get a calculated stock price of 128. They're trading at 237, so they're trading at an 85% premium. It's a big sell according to the model. There are 146 companies in the same industry as ZS, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 130 million in capex. That's between the median and average. They're a bit leveraged. Their debt to equity ratio is close to the average, a lot worse than the median. For every dollar of equity, they have $1.50 of debt. They do not pay a dividend. They generate a little less than $500 million in free cash flow. They rank 10th in market cap. Lots of big companies in this industry. All their price multiples are a lot worse than the median. They're also all worse than the average, except price to sales. Price to sales is a little better than the average. They generate 1.8 billion of revenue, which is between the median and average. In terms of revenue growth, they're the biggest in this industry. Their 5-year annual revenue growth rate is growing at 52%. Let's take a look at their most recent 10Q. This is as of 10/31, so the 3 months ending 10/31/2023 versus the 3 months ending 10/31/2022. Revenue is up a lot from 355 million to 496 million. Let's see if they give a breakdown of the revenue. Exactly half their revenue is in the US, 247 million, 157 million in EMEA, that's 32% of their revenue, APAC 75 million, 15%, and other is 17 million. The great thing about a company like this is they can easily scale and sell their product all over the world. If you don't want to use a VPN, this is a great substitute. Their technology is supposed to be a lot safer than a VPN. Here's a different breakdown of their revenue. Of the 500 million, 450 million is from channel partners, 42 million direct customers. Let's go back to the income statement. Below revenue is the cost of revenue. These are all the expenses directly tied to generating the revenue. Revenue minus cost of revenue gives you your gross profit, 385 million. That's up from 278 million. Their biggest operating expense is sales and marketing, 267 million. That's up about 40 million from last year. R&D is also up quite a bit, 113 million. G&A is 51 million. Their operating expenses are higher than their gross profit, so they have an operating loss. They had a loss of 69 million last year, and now it's 46 million. They do receive 26 million of interest income on their investments, so their net loss is 33 million. But you see they do pay taxes. They paid 9 million of taxes last year, 4.7 million. Because when you strip out the non-cash items, they are a profitable company. But they have an accounting loss because of all the non-cash items on the income statement. We'll look at the statement of cash flows in a little bit and you'll see what I mean. Earlier, when we looked at my Excel file, they had a net loss every single year, but positive free cash flow. And they're adding shares. Last year they had 143 million shares outstanding. Now they have 148 million. Let's take a look at their balance sheet. Current assets of $2.9 billion, current liabilities of $1.5 billion. So their current ratio is about a 2. They're a pretty liquid company. They have $1.4 billion of cash and almost $1 billion of short-term investments. Lots of cash. Accounts receivable, $367 million. This is what their customers owe them when they sell on credit. Deferred contract acquisition cost, $119 million. It cost them a lot of money to acquire new customers. Instead of putting all those expenses onto the income statement, so they spread the expenses out over several years. Say it cost them $10 million to acquire a new customer, and that new customer signed on with them for a 5-year contract to pay Zscaler $50 million. Well, since Zscaler spent $10 million getting the customer, they spread the expense over 5 years. So $10 million over 5 years. You can see deferred contract acquisition costs in the current section, and also $250 million in the non-current section. $266 million of PP&E, property, plant, and equipment. And most of their PP&E is technology equipment. Hosting equipment, $307 million. Capitalized software, $133 million. When you acquire another company, you could capitalize some of the software through that acquisition. You cannot internally capitalize software if you internally create it, but you could capitalize it if you acquire from another company. They have $92 million of goodwill. So total assets, $3.6 billion, same as last quarter. They have $2.8 billion of liabilities, same as last quarter. Their biggest liability is deferred revenue. So if a customer pays for a year up front for their service, they have to carry that in the balance sheet as a liability and pass it on to the income statement each month. They have $1.1 billion of convertible notes. Hopefully the stock goes up and this debt converts to equity. That's one of the benefits of a company's stock price going up, is that the debt converts to equity and it strengthens the balance sheet. They talk about the convertible notes right here. Issued in June 2020 with an interest rate of 1/8 of 1%. That's a really amazing interest rate. Assets minus liabilities gives you your equity of $800 million. That's the value of the company according to the balance sheet. They raised almost $2 billion from selling their business, and they lost $1.1 billion from running their business. Let me show you why they're cash flow positive. We'll look at the statement of cash flows. Operating cash flow is how much cash the company generates from running their operational day-to-day business. Net income is a company's accounting loss. It's not actual cash. They had an accounting loss of $33 million. But as I suspected, they pay a lot in stock-based compensation, $129 million. So you have to add that back on a statement of cash flows, because that's an expense on the income statement that brings down your net income, but it doesn't affect cash flow. They also had a cash inflow of $215 million in accounts receivables. So this is when they sell on credit. Those customers are paying them this accounting period. So they're actually generating a good amount of cash flow, $260 million. Almost exactly double last year's of $128 million. I might invest in this company. It looks really attractive. They spent $29 million in PP&E, a little more than last year of $25 million. Not much going on in their financing section. They received $1.3 million from issuing stock options. Let's look at them on Simply Wall Street. Price of $237, $35 billion market cap, up 2% in the past week, up 86% in the past year. I hope I didn't miss the big run-up. It's up quite a bit. Let's see what they say about them. They operate as a cloud security company worldwide. They offer Zscaler internet access. You can feel real secure using their software. It should limit cyber attacks and gives you peace of mind. And you could use their software on pretty much any device. They have customers in the airline and transportation industry, large conglomerates, consumer goods and retail, financial services, healthcare, manufacturing, media and communications, the public sector, education, technology, and telecom. They used to be known as Safe Channel, and they changed their name to Zscaler in 2008. It's a pretty cool name. They're headquartered in San Jose, California. The stock IPO'd in 2018 at about 28. It peaked at 355 in 2021. It did drop to below 100 about 8-9 months ago. But like most tech stocks, a big run up in the past year. It's at 241. Still about 30-40% lower than its peak. Simply Wall Street says the stock is undervalued by 11%. Their target is 267. 41 analysts priced this stock at $240 where they're trading at. Their revenue target for 2024 is $2.1 billion, 2025 $2.6 billion, and 2026 $3.3 billion. Lots of projected growth. And their free cash flow estimate is $800 million by 2026. My model is a bit more aggressive than them. I'm at $1.2 billion, and the stock still seems overvalued according to my model. But I've bought stocks that are overvalued, and I sold stocks that were undervalued. Because there's more than just predicting the future cash flows. There's also market sentiment. You could predict a stock price perfectly, but it could take a decade to get there. A lot of people don't have the patience to wait that long. They were debt-free in 2017, 18, 19, and part of 2020. Then they started adding some debt. They're up to $1.1 billion. And their debt is higher than their equity. Their equity is $800 million, debt of $1.1 billion. So their debt to equity is 141%, or 1.4. But this green line is their cash. They have lots of cash on their balance sheet. When the cash is higher than the debt, you can consider them debt-free. Look at the CEO's salary. In 2018, it was $96,000. Now it's down to $24,000. But his total compensation is $58 million. That's stock-based compensation. And he's been the CEO for 16 years. In the past 12 months, only insider selling, no buying. About 200,000 shares were sold by insiders. Half the company is owned by institutions, 38% by insiders, and 14% by the general public. Ajay Mangal is the biggest shareholder at 20%. The company's CEO and founder, Jagtar Chowdhury, he owns 18% of the company. Then you have Vanguard, BlackRock, Voya, State Street, Alliance, Two Sigma, D.E. Shaw, Fidelity, Franklin Resources, Renaissance. Their employee count has grown a lot from 600 in 2016 up to 6,000. That's a 10x growth. And the ticker trades on the NASDAQ, London Stock Exchange, Mexican Bolsa, Zicha, Wiener Bourse, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.